You're welcome to another edition of the Market Review, where we bring you key developments in the financial and capital market as it relates to the economy. As we are already in the second half of the year 2021, we'd like to discuss the developments around the fixed income and bonds market. What would the outlook be, and what are the key things that are going to shape the market? With me to have this conversation is Mr. Oluseyi Akinbi. He's the Managing Director of Zedcap Partners. Nice to have you on the program, Mr. Oluseyi.
Thank you very much, Otto.
Very well. Let's take a review of first half of the year 2021 for the fixed income and bond market. A lot happened. We'd just like you to give us a synopsis of what are the key things that happened. We know that monetary policy continued to play a key role in that regard. Yields had up and downs, but in a general analysis, how was the first half of the year 2021?
Okay, thank you very much for the question. And then I will start by giving a brief background of what happened in the previous year, so we can sort of appreciate the happenings in the first half of 2021. 2020 was the year we saw yields get to like a decade low. We had treasury bills trade as low as 0%. And then bond yields also traded as low as 7% on the long end of the curve. And then coming into this year, we've seen aggressive reversals into sentiment. We've seen yields from a low of 7% on the longer end of the curve get as high as 14.2% as at the last auction. Also for the NTB space, we saw yields, PMA yields, starting the year at around 0.15 on the long end of the T-bills curve, to as high as 10.5% yield. And all this has been because of these various happenings that we've seen across the world. In the international markets, in the global space, we've seen the same happenings, whereby the expectation for inflation after a lot of COVID spend has impacted the sentiments in that market. And then we've seen yields also reverse on the 10-year US bonds. We saw yields get to as low as 0.5, and as of today, I think they're yielding at around 1.5. So Nigeria was not also spared. We've seen that aggressive reversal happen. Also, another sentiment that has played was because of the large borrowing appetite of the federal government of Nigeria. And the plan was to borrow around 2.4 trillion from the local markets. And then we saw traders and also investors react to that large issuance, trying to dump their holdings in the anticipation of reinvesting at a higher rate. And also we've seen a lot corporate issuances. The likes of MTN and Dangote have also come into the market to take advantage of the lower yields that we saw around Q1, and then also, competing for the available funds that were in the market. So all this all together has led to a sharp reversal in yields in the first half of the year.
I think the last part is even the one that's really caught my attention, the corporate commercial papers issuances. So many, from Dangote to BUA, Coronation. I mean, various players in the market have come on board to leverage. Even MTN, like you said, is showing the fact that they're taking advantage of that low yield environment. And if I'm right, you were talking about the fact that it was the bond yields that was as low as around 7, that went up to 14% at, I think, the first half of the year, the bond yields.
Yeah. The long end of the curve, the 2049 and the 2050 bonds, got to as high as 14.3 to be exact, right? Coming from around 7-8% at the beginning of the year.
Quite interesting. And again, we will come to that, but we're seeing the federal government already showing the signal again that are going to leverage the domestic market in terms of borrowing. So that will be an interesting area. But let's look at a very critical part. I mentioned the monetary policy rule this year. I mean, last year, a lot was said around how monetary policy impacted the fixed income market activities, from treasury bills to the yield curves. But let's look at the recent decision by Central Bank of Nigeria to strengthen that drive for a transparent and liquid foreign exchange market. The FMDQ commended the CBN for that, and economists, analysts, and experts are happy that we're beginning to see some clarity, certainty, which has always been the concerns around the foreign exchange market.
Yeah, okay. Speaking to the FX markets, I think the CBN has been a bit challenged, right? What we've seen is the CBN has not sufficiently supplied or filled out the demand that we've seen in the interbank market. And then they've continued to use their demand management strategy and also import substitution techniques, right, to continue to manage the pressure on the FX side. And all this came from the COVID, right? We had crude oil prices crash to as low as $25 per barrel last year, and that took a very big impact on the reserves.
And it's picking up now.
Yeah, it's picking up now. We're around $71, $72 per barrel at the moment. But no, it's a double-edged sword too for them, because the production limit also has sort of contained the accretion, exactly, the accretion to the reserve. So that's why the fact that crude oil prices are up and yet to date, we've seen a very, very slow accretion to the reserves also, and that has sort of constrained the CBN from intervening aggressively in the interbank market. But what we've seen that they've done over the past 6 months is to continually move the peg of the exchange rates, coming from around 360 last year. They moved it a bit to 379, and then of recent they took down the rates, the FX rates section of their website, and then came back to put feedback and update it that the new rates at which all transactions will be conducted will be the NAFEX rates, which is around 412, 413 right at the moment. So the CBN is gradually leading the market, right? And they've already told everyone that they are not willing to devalue the currency aggressively because of the impact and that it will have on the economy, inflation, and of course, they believe that it's a power to the misery of Nigerians at the moment. So that's the reason why they are taking a steady approach to manage the resources that are available at the moment. Well, they are trying their best from what I can see, but I think they are more constrained, and we are hopeful that by the time they're able to raise, the government is able to raise some dollars from the Eurobonds market, and of course, if the IMF and the World Bank also grants us some of the monies that they promised, we believe that the CBN will be in a better position to make the market much more liquid.
And the NAFEX, like you rightly said, the FMDQ commended the CBN for leveraging that NAFEX rate for the exchange rate market. Do you also agree that it's going to guarantee transparency and certainty in the market, or do you have concerns around it?
Well, I think it's a step in the right direction. The World Bank and the IMF have always sort of put pressure on the CBN to narrow the rates, number one, and of course they want a singular rate, a singular FX rate in Nigeria. At the moment, the CBN has various rates. There's a separate rate that they sell to the BDCs, which is around 393. Yeah. They have a rate at which they sell to the to the manufacturing sector. They have a different rate at which they a lot of rates in the market.
There are too many windows. We need to just synchronize them.
Exactly, and is the harmonization of the rates that everybody is asking for. So I think it's a step in the right direction, right? The CBN is now referencing the NAFEX rates, which was something that, it took them a lot of willpower to do. And we are hopeful that if the NAFEX rates, which is sort of where most of the transactions in the country happen, if the CBN is willing to reference that rate, then we are sure that instead of the NAFEX rates pulling to where the parallel market rates are, the primary market rate will be the one to adjust to it. So it's a step in the right direction. And I believe more transparency and more liquidity will begin to happen as the CBN continues to intervene in the market.
Very important. And I like that part. When they reference the NAFEX rate, it will bring more liquidity, transparency, and boost investor confidence. As you know, investors, whether foreign portfolio or foreign direct, are always particular too about how our exchange rate market is. Now, let's look at the second half of the year. We're already, mid in it. What do you see as the key developments that will shape the fixed income and bonds market? I'd like you to first, the recent statement by the Ministry of Finance, Budget and National Planning, that's proposing the supplementary budget of about 895.84 billion naira. And they're saying that they're going to borrow from the local and the international market. So how would that first particular step impact the market?
Okay, of course, definitely. With increased issuance comes the pricing. So what we're expecting is we're expecting investors, once the Senate approves it and then it's signed into law, we expect the markets to react accordingly to the increased issuance. I think in total, as you said, it's around 900 billion naira that will be raised in that market. And of course, looking at the sentiments that has dominated the market since the beginning of the year, we expect the bearish momentum to sort of catch up with that announcement. Of course, again, what we can also infer is that the CBN is a bit reluctant to tighten policy. So that has sort of created an equilibrium.
It's taking a pro-growth approach.
Exactly. They have created a bit of equilibrium in the market whereby we are not seeing rates on the bonds, on the treasury bills go as high as what we think it should have gotten to. The CBN has decided to chase a growth mandate for now, supporting the economy in the light of the COVID-19 impact. And then we believe that once the growth story changes in the we're expecting the Q2 GDP to come out probably later next month. If the growth numbers are beginning to look attractive, we believe that the CBN can immediately go back into a full tightening stance, whereby they take up the MPR rate, and then we can see other rates tied around the MPR also move up. So, it's two-pronged. If we see the economy grow at the pace that is comfortable, we believe that the CBN will go back to their price management mandate. But if growth is a bit very slow, we believe that the CBN will be very, 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 very slow in their approach to interest rates. Exactly, managing it for now until the see things improve. So we believe that all these happenings are what will definitely shape the sentiments around the fixed income yields coming in the next half of the year.
And then in terms of commercial papers, definitely we're going to see much more. I mean, it's like it's flawed. It's like a flood in the FMDQ particularly. We're just seeing the releases published every week now. One company is coming on board.
Exactly, because the commercial market paper market, got a lot of patronage last year with the yields, getting as low as with the fixed income yields. The treasury bills getting as low as 0%. So a lot of corporates took advantage of that opportunity to raise commercial papers. And we think that that appetite will continue, despite the fact that rates in the market have sort of gone up. It is a much more faster market to raise money. It is a cheaper market for the corporates to raise money. It is a more sustainable way for the corporates to raise money. And we believe that, the issuance of commercial papers will also continue in tandem with the needs of the corporates going forward.
Mm. Oh, very interesting. I mean, that CP part, I mean, we're going to see more of that in second half of, but in terms of fiscal policy, is there one or two things that fiscal policy could do that will impact the market in second half of the year, apart from monetary policy, like you said, if the economy
On the
is
fiscal
growing?
side, the fiscal policy has been on an expansionary spree. The Buhari government has increased our borrowings by about threefold since he joined the government. So of course, we know that the government is very, very, they have a very large appetite for borrowing. And on that factor, as you said, just yesterday, they sent or they are going to send a supplementary budget of 900 billion to the Senate for approval. So definitely, in as much as is there to borrow, we will continue to see that impact in our local fixed income markets, whereby investors will continually demand for higher yields as the government comes to borrow funds in the market.
Yeah, that higher yields is really needed, because last year the yields were low and people were like, wow.
Exactly. And even at the moment, if we want to compare it to the previous years, from what we used to know, inflation at the moment is around 18%,
Yeah.
right? The investors are still, investing negatively, if you might put it that way, because the real returns from investing, which is the difference between the inflation rates and then the whatever yields that are on the fixed income, are still largely negative. So that's what we believe that the CBN will try to correct. The international markets have also been craving for it. They believe that the yields in the markets are not reflecting the proper fundamentals, and until the CBN is able to correct that notion, and they won't come to the market. So we also believe that as the economy grows, the CBN will go back with a price management mandate, and then they can reflect this strategy going forward.
Okay, so what will you be saying to investors this period, those particularly some friends that I know that they are watching the market and like things to happen? I mean, they expect, like you rightly said, good yields.
Okay, so I think my advice to investors is we are firmly back at double digits, right? There's no need to panic. We believe that if the CBN is willing to attract foreign investors back into the market, they will need to take short-term rates up aggressively. And if that happens, local investors will also be able to, get higher returns on their investment. So we still maintain a posture of the CBN trying to correct that notion, probably in Q3 of this year, where the CBN might be looking at, taking rates up and then, increasing the yields on the shorter end of the curve, just to make sure that investors don't suffer negative real returns on their investment. So our outlook is we still believe that rates will go up, and then investors should be patient, invest at the short end of the curve, and wait for the yields to go up to reinvest. So that's our advice to investors generally.
Very interesting to know that the outlook is that the fixed income rates and the yields will definitely go up. But you sound confident that we are back to the era of double-digit yields. That's good to hear. And the need for Central Bank of Nigeria to take short-term rates aggressively. The correction is very important, like you said, from the Central Bank for investors who look at the market. And yeah, that's very clear, and hopefully we would get much of this. But in 1 minute, when you look at the activities of the Debt Management Office, are you seeing that their actions incentivizing investors, particularly as we go to the international market too? to participate?
Okay, so I think my view of the debt management office is that they are doing their best. They have just only one job, and the job is to fund the government in the most cheapest and the most fastest way, right? And I think they've done a great job. From the local markets, I think they've been able to raise well above 1 trillion naira year to date. But the major challenge has been the offshore or the foreign borrowings, which is sort of tied to a lot of conditions, not the conditions that the DMO itself or the debt management office can fulfill. A lot of these covenants are tied to what the fiscal arm needs to effect, right, for them to get all these funds. I believe that there's still a lot of appetite for Nigerian debt internationally, especially for the Euro bonds. The last time Nigeria came to the market was in 2018. So of course, they've been a very, very long break. And I'm very confident that if Nigeria comes to the market today to raise their plan to raise between $3 to $4 billion, I'm sure they'll get that. But of course, the government is also very, very cautious. They don't want to aggressively raise foreign debt at high rates. And that's why I believe that they are still waiting to streamline fiscal policies to what the concessionary borrowers will need, which is the World Banks and the IMF. Once they're able to do all the things, all the conditions precedent to it, they'll be able to get funds at a much, much cheaper rate, right? I think ideally, the rates are usually between 1 to 2%, which is way, way cheaper than going to the Eurobond market, where they will actually raise between 8 to 9% at the moment. So we believe that is what will shape, happenings from the DMO office. If they are not able to secure concessionary borrowings from the IMF and the World Bank, then we'll see the DMO float Eurobonds to support the budget. I think we're already at this is the 6th month of the year. If you really need to do anything, if you've not done anything in the year, you need to quickly start, raising money. They need to start spending aggressively to meet, their budgetary expenditures. So of course, we will see more clarity as regards that going into the second half of the year.
Thank you very much, Mr. Oluseyi Akinbi. At least you've given some hope to investors that definitely fixed income markets, the era of good yields have returned. So let's hope that that plays out. All things being equal, like they say in economics, central bank monetary policy, fiscal policy, and other players do what they have to do. Thank you, Mr. Oluseyi Akinbi, Managing Director, Zedcap Partners, for this interesting conversation as we looked at what will play out in the second half of the year 2021 as it concerns the fixed income and bonds market. We hope to have you subsequently to discuss around these developments in our future editions. Thank you once again.
Anytime.
Thank you. And that will be all for this edition of the Market Review. If you have questions or comments around our conversation today around interesting developments that we should expect in the fixed income and bonds market for second half of the year 2021, you can send your views and comments to otuabasi.abasiekong@proshareng.com. That's displaying on the screen for you to get. And also, if you have any additional desire to get more insights on what this discussions around fixed income and the bonds market, log on to our website, www.proshareng.com. When you click on it, go to the right-hand side of the bar, scroll through our segments, you'll see the fixed income and bonds market. If you click on it, you will even see articles and reports from Zcrest, that's Zedcap, one of the players in the industry, other players in the industry, and what FMDQ, major market exchange in that segment, is doing around the market. So if you're a big player in that market, we got you covered in that space. You can also follow our social media platforms displayed on the screen to get further updates and insights. Don't forget this period that you need to stay safe. Thank you for being part of this show. Hope to have you in subsequent editions. Stay and have a nice day.